Very warm welcome to Kemira's CMD 2017. My name is Olli Turunen and I'm Head of Investor Relations at Kemira. Today you'll hear deep dive into our businesses and how we're delivering profitable growth. In addition to the speakers on the stage, we have the whole management board here in the room, if not presenting, then in the audience. So let me briefly introduce those who are not presenting. First, Heidi Fagerholm. Heidi is responsible for our R&D. Heidi is leaving Kemira to join Merck. We're in the process of searching replacement and we'll announce that in due course. Then Eeva Salonen, responsible for human resources, and Esa-Matti Puputti, responsible for operational excellence. So please use the opportunity to discuss with our management people during the breaks. Welcome also you who follow the event via the webcast. You will all have a chance to ask questions here in the room after each presentation, and then we will have dedicated breakout session at the end of the day. Before we start, a word about safety. So in the case of evacuation, please use the exit behind the stage or in the back of the room. We will start with our President and CEO, Jari Rosendal. So Jari, please go ahead.
Thank you, Olli. Welcome all on my behalf also, and good morning and I guess good afternoon to some of the webcast. I'm going to go through where we are in our strategy execution, how our markets look like, how they will be developing, and how we continue to develop the business. We have nothing majorly new to tell today, or not big plans to tell, so it's more of an update on where we are and where we are going, and certainly driving to meet our financial targets, which are unchanged. Looking at what Kemira is today, and this is reflecting to full year 2016 figures. So a bit under 2.4 billion last year in revenue, and operative EBITDA, which is our main KPI for profitability, was a bit over 300 million, representing 12.8% margin. We operate today through two segments. We consolidated the former M&I and oil and mining into industry and water. That represents, in last year's numbers, just under 40% of our revenue, and pulp and paper, a bit over 60% revenue. If we look at where the business comes from, a bit over 50% comes from EMEA. It says Europe, but that includes Middle East, Northern Africa, or Africa and Russia, for instance. And also the three biggest markets by countries are mentioned there. Americas, North and South represent almost 40% and 10% from APAC. From a product and technology point of view, we can categorize our portfolio into five buckets. Bleaching and pulping chemistry and technology, coagulant for water treatment, polymers for all of our businesses, whether pulp and paper, water treatment, or especially oil and gas, sizing and strength, and then a basket of specialty smaller product lines. And in total, those product lines represent over 2,000 products in our portfolio, including product variations. We serve over 8,000 customer corporations that have 16,000 shipped to customers, and you can see examples of names of our largest customers in our portfolio, whether pulp and paper, whether oil and gas, whether industrial players or municipal players. From our 2.4 billion, we have some customers that exceed 100 million revenue in a year, so we don't have dominant customers, and those 100 million exceeding customers, they have multiple ship-to addresses, even globally. Some play centrally their business with us, and some play decentrally their business. This represents and illustrates how we operate and plan our strategy on organic growth acquisitions, driving efficiency and our cost discipline. And our financial targets are above the market growth and reaching operative EBITDA of 14 to 16%. In organic growth, I'll start from there. We've been investing into capacity in areas where we see further growth in the future and where we see also our capacity being constrained. Seizing opportunities in growth pockets, whether it's new geographies, new customers, new application. Some of those applications are shale and oil sands and EOR to come. APAC is a growing area. Obviously, R&D is a cornerstone. And we haven't talked about a lot of digitalization. We are not newcomers to that. We've been dealing with that quite a lot inside our own operations, how we collaborate with the customers, and there are programs ongoing in that area going forward. Acquisitions, we are very selective and careful with acquisitions, and you've noticed that in the last 2 years we haven't done anything major. So we continue to monitor the market, and I'll talk more about that later. Efficiency, there's inherent complexity in the environment that we work, so there's more opportunities on how we develop our efficiency, our manufacturing footprint, how our operational excellence goes. And last year we introduced our Boost program, and now we've also adjusted our organizational structure and work on simplifying our complexity. And operating cost discipline goes without saying and is self-evident. So these give the areas that we focus on when we look at doing the business. And here's the proof of putting what we've been actually doing. I won't go through this in a detailed way, but you can see the dots under the title. Green dots represent opening or expansion of new sites. Blue ones, acquisitions. There's 3 smaller ones and 1 bigger one, which is the AkzoNobel one. Operational efficiency actions, and then optimizing our footprint, meaning closing and consolidating our sites. If you look at the last year, we have done expansions on many sites. Those represent our polymer product lines or polymer technologies. And last one is now in Q3. We had just a couple of weeks ago started up our investment in Finland, in Joutseno, for a new chlorate line for growing pulp and paper, and are ramping that up. So that's going well. The purple ones are about operational excellence. There's modernization of our production line in Holland, so not everything is expansion. And then the Boost program, under the Boost program, our transportation activities with Odyssey, and then the segment structure things. So when we look at the circle, these are the steps that we do, and we mention obviously just some of them and the major ones of them, so you can see that what we are doing. Now this has resulted to this type of financial development in revenue and profitability. In the last couple of years we've been able to grow our revenue 300 million and our profitability on operative EBITDA about 50 million. And why I'm saying this is at the same time during 2015 and 16 our revenue in oil and gas went down by 70 million and our operative EBITDA went down by 30 million. So still we were able to come up. Last 12 months, some volatility in the beginning of the year in raw materials, but mostly we look at this on a full year basis because some of our actions hit and come on stream at certain points. So when we talk about things, we talk about longer term and a full year basis. Going to our relevant markets, so the markets that are buying our type of products, technologies and chemistries. And if you look at the long-term drivers, they are favorable to our customers and therefore for us. And they're not short-term, they're better sort of long-term of growing middle class, recycling, of regulation and scarcity of resources. Nothing new there. But if you look at the growth in the segments, pulp and paper, 1% estimated growth year on or per annum next years to come. There's more growth in the pulp, packaging and tissue board areas, and there's decline in the printing and writing area. But the average chemical consumption market growth is then 1%. We are 80% exposed to the pulp, packaging, board and tissue area, which is growing faster. And during the last years, we've been flat on the printing and writing revenue. So therefore, we believe we can grow faster than the market and actually have been able to prove that. Water treatment, 2 to 3% growth in chemicals years to come on an annual basis. So steady business, not huge growth, but still steady growth, and we've been able to match that growth. Oil and gas, 5 to 6% now per annum. Last year, we reported that we saw 2 to 3% growth, but now the industry is back in shale and other oil and gas producers. So our customers have updated their outlook for growth, and that shows 5 to 6% growth opportunity. And if you look at the total, then we're talking about something like 2 to 3% market growth going forward, which is quite a good basis to be in. APAC, obviously, of the regions, grows fastest, and growing fastest in the pulp and paper packaging board and paper side. Also water treatment growing there. We're not that heavily exposed to APAC oil and gas, but we have some exposure there. We've been able to grow our revenue and double it last 2 years, partially because of our own investments to APAC, namely China and our Nanjing site there in 2013-14. We've expanded it further. We've also, through the Axo acquisition, added 4 more sites to Asia Pacific, so really going to that direction. You can see also the operative EBITDA improving, but it is very competitive market, and although our operative EBITDA has been improving, I cannot be happy about the level yet, so we have to still work on improving that. Luckily, there's growth in the market that we can continue to improve and work on that. Innovation, R&D drives growth, and we innovate with our customer, with our partners, and in open innovation. And as I talked about digitalization, we look at our own performance and then looking at services to the customers. And we put our digitalization initiatives into 3 baskets. Digital workplace or digital worker, on how do we equip ourselves being more efficient and having more access to information. And the operation is quite global and mobile, so that's needed. And then the enterprise side on how do we drive our processes, how do we drive our systems, how do we automate things, how we even use artificial intelligence to analyze and do those things. And that's what we're doing. Also, a digital business, so how do we bring new services or stickiness for our customers. And we have about 200 connected customers where we are online looking at what they are doing, already giving them services of remote monitoring, and over 30,000 instruments out there that we are monitoring on what's happening and gathering information all the time, which is then benefiting on how we develop the processes. 250 R&D experts in our 3 centers, and we actively patent. I believe we did 46 new primary patent applications last year, so that's a good step forward. So how do we measure then that financially? And one KPI is looking at our innovation sales, which means revenue from products or services that we have developed during the last 5 years. And step by step, you can see that we reached 9% last year, and continue to do that and invest into our R&D pipeline, refreshing that all the time. This is an important factor because then we regenerate our offering to more sustainable products and offerings going forward. We invest about 32 million a year into R&D and technical customer service. Technical customer service is an important part for launching our new product, supporting the customers, and also getting feedback from the customer processes and feedback on what we should develop next and which type of issues the customers are dealing with. Last year we introduced our operational excellence program, or Boost, And if you look at the complexity, I talked about the customers, but 13,000 suppliers, over 60 manufacturing sites, global warehouse network, products and shipped to customers. So it is a complex environment. Even if you have those numbers, it's still complex. We operate quite well, but there's a lot of opportunity with new tools and thinking on how our processes go, and that's why in the Boost program we're targeting 20 to 30 million of operational savings and optimizing our net working capital. One of the areas is logistics and transportation. Our inbound, outbound logistics is about 240 million of cost a year, and our road transportation is roughly 170 million. And last year we entered into a contract with Odyssey, which is a company that handles over 2 billion worth of transportation services to chemical industry customers. And they are going to, in the future, run our road transportation in North America, so sourcing it and managing for us. We still pay the bills, so we don't outsource it to them, but they manage it. And we went live last spring in North America. Not without hiccups. It took a while to get stable, but now we are improving steadily and starting to see gains this winter, and soon we will also go live in Europe. And this transportation part is going to yield a good part of that 20 to 30 million target, start to get the run rate next year. So all of these things that we are doing are here in the bridge on how do we go from today's level to the targeted 14 to 16% level. Akzo paper chemical business integration is in last month, so we will complete that by the end of this year and have the full run rate starting next year of the 20 million synergies. Our original target was 15 million, and we were able to update that to 20 million last year. We consolidated our structure, streamlined our management layers, and went from 3 segments to 2 segments. So that efficiency from there was estimated to be 15 to 20 million. We will have a full run rate by the end of this year on that also, and we're hitting roughly the midpoint of the 15 to 20 million target level. Investments are coming line that we have been building now. One example is the new chlorate line in Finland, and we are ramping that up successfully a bit ahead of schedule as we speak, and we will have it fully up and running. And as I said, the contracting of that new volume has gone really well, so we can get the full benefit. Timing for completing that project was pretty good for us. On the previous page, I talked about the Boost program and the transportation, so that's the component there. And then the oil industry is recovering, so obviously shale, oil sands, and then our continued work on oil, chemical enhanced oil recovery that are coming, and then advanced water treatment to do a bit more on packaging technology and different chemistries, and Antti will talk more about that. So those are the main steps going forward, obviously running the day-to-day business and improving also smaller things and how we operate and our processes, but these are the main steps. On the grayish color, last you can see the volatility, so there are raw material volatility or exchange volatility and various disturbances, so those we then have to deal with, and that's why we have the 14 to 16 window, always trying to hit the 15% mark in the middle. And talking about disturbance, we had a few weeks ago the Harvey hurricane, and quite soon after that Irma. Harvey hitting the Texas area with a storm, and especially the floods, and Irma hitting Florida and the southeastern states of US. And this obviously hit the Texas area, but the first priority of course for us is safety of our people, and I'm happy to report that our people are safe, their families are safe, so that's good to see. There's some logistics and production issues, especially in Texas. Many refineries, as you know, chemical players had to shut down and evacuate. And after they started up, which they are now in process of doing, and many have started up, then the logistics and value chains were disrupted. Our own manufacturing sites, which mostly are located in the Southeast states, were not impacted, so no damage done. We had to shut down a few sites for safety reasons for a couple of days, but we are back up and running. Also, our customer sites were not impacted, so no big disruption there. So limited impact as we can see now. We're not back to normal yet in the raw material chains, but that's the situation that we are monitoring and hope to get back on track full steam in the next days or couple of weeks. In the quarter, we had acquisitions, and as said, there are a list what we've done in the last 3-4 years. Two bigger ones there, the 3F Polymers and the AXO. And we look at full integration. We look at complementing technologies and know-how, expanding to new products. We look at consolidation of the market, or expanding and strengthening our business to geographical territories where we are not that strong yet. And all of these need to be EBITDA enhancing, hopefully second year, full year after closing the deal. And as I said, we aim for full integration on what we are working on. 2015, 16, and 17 have been a high capex investment plan for us, knowingly that it's above our cash flow generation, so we have knowingly generated some debt in the system. We've been putting into chlorate, polymers, modernization technologies, into sizing products, and so on, and that's the situation. Going forward, we want to balance our capex and cash flow so that we don't grow our net debt anymore. I'd like to point out that all the growth capex that we've been doing, including the acquisitions that we are doing, are much higher in targeting operative EBITDA than the 14 to 16% window. So they are clearly accretive when they are coming, and you can see some of those things in the ladder going to the 14 to 16 window. So more balanced cash flow and capex going forward. As a summary, we still have opportunities to invest into growing applications where we see our capacities hitting a limit. We have also opportunities to invest into co-invest with our customers. One example is what last spring we started up our Klabin site in Brazil, where the customer invested to a greenfield pulp mill. We co-invested right next to their plant. We have those type of opportunities on top of traditional investments in pulp and paper and in industry and water. However, from now on, we will look at our capex spend more in balance with the cash flow and not grow our net debt. We are working on the increased efficiency, and we are working on to innovate and drive our product pipeline, and certainly work hard to reach our financial targets and the 14 to 16% EBITDA, and our financial targets are unchanged. Thank you. That was my portion, and we'll go deep dive now next after some questions to the other areas.
Thank you, Jari. So we will take a few questions now here in the room, and if you wish to ask a question via the webcast, please type them in and I will then pick it up here on the iPad. Before asking a question, please state your name and company.
Robin Santvirta, Carnegie. Can you talk about M&A a little bit more and perhaps capital allocation? It seems as the AXO acquisition actually was very successful for you guys, truly quite significant synergies. Any other similar type of targets around anything you're looking at? And also, I know there's some quite big companies, sort of much bigger than the Actso acquisition. Could that be interesting for you guys as well?
Mm-hmm. Well, like I said, we keep our ears and eyes open and look at it all the time. So industry consolidation, adding technologies and capabilities or geographical things. And if you think of the Actsos and the polymer deals that we have been doing, they fit that criteria and they have to be synergistic and accretive. So that's what we are looking at, but also what you can see, we've been very careful and not bullish about that, obviously understanding the limits of our balance sheet. So there are opportunities out there. Valuations have been high lately in many areas, so we're sensitive to that, we don't overextend ourselves. Going any deeper into your question is not something that I'm obviously not willing to do at this point.
Thanks, and one more, if I may. Regarding production, the 2,300 product sort of areas or products you're selling, and also the 63 manufacturing units, is this something that could yield, or consolidation of these that could yield some kind of profitability improvement in future, and is this a focus area for you?
Well, it's always optimization of the footprint, and obviously that's through to historic acquisitions and the industry being built from small local units near the customer site. So that's just the nature of the beast. But if you look at what we've been doing on the action list, we've been even shutting down, I think, 4 sites during the last couple of years. So we're continuously looking at that. How do we consolidate our manufacturing? And actually the Actso deal was part of that. They are now closing down 10 sites or have already closed down sites. So that's in our radar, but we regard that also as an investment. So it needs to have the criteria and payback that we are looking for, or then we have alternate things. So certainly on our radar all the time.
Good, thanks.
Let's take one more question.
Panu Laitimäki, Danske Bank. I have a question about CapEx. You aim to balance cash flow and CapEx. Does it mean that you are looking for a specific number in terms of CapEx to sales or absolute CapEx in euros?
Petri will talk more detail on the balance sheet issue, so if I'll defer that to that. But what I'm saying is that the time of spending on CapEx versus our cash flow now comes to more balance. And then we have to look at year on year, quarter to quarter, but I'm more looking at 2 to 3 year basis of it, that we don't grow our net debt. I've often said that the leverage ratio of 2.5 is the sort of the pain point where I see as we cannot exceed, or then it's just for a short while so we can come back and know that.
Thanks.
Let's take one quick question here from the iPad, from the audience. There's a question. Has there been increased awareness to increase water treatment in China now that the environmental focus seems to be tightening on the metals markets, for example?
Simple answer is yes. Antti will cover that a bit more in his presentation, so I won't take his theme, but the focus has been quite a bit on the air quality, and now it's moving more and more to the water quality in China, but I'll let Antti to discuss that in his talk.
Excellent. Let's move on. More questions can be asked to Jari in the joint Q&A with our CFO at the end of the day. Now, for the next speaker is Kim Poulsen. Kim is known to those who followed last year's CMD. Kim, please go ahead.
All right. Thank you, and Jari, thanks for the update. So, a brief summary of our business. Top 50 accounts 1 billion. 75% in mature markets, 25% in emerging markets. Growth last 3 years, EBITDA improvement 50 million in the last 2 financial years. And we are the number 1 globally. Jari talked about this, the share of the growth business, which is pulp, board and tissue. That's 80%. and 20% is in the printing and writing, but that's mainly with the, let's call them healthy accounts with a good balance sheet, so not the weakest players in that arena. Last year there was Mr. Jyrki Ovaska, my former colleague, and one of our biggest accounts. The EVP from their side was presenting a video asking for certain improvements from us and from the cooperation with Kemira. And now we have worked 12 months and we take customers seriously, so I'd like to play you a video what has happened in the customer's eyes in the last 12 months.
We at UPM feel that there's been clear improvements taking place during the past year, and those have been primarily in the areas of what we have established the top level strategic alignment practice, as well as we've moved on in the Finnish chlorate business. The main point is also that we have done all this under much better spirit and perception of customer friendliness on our behalf, and in that respect communications clearly have improved as well. So let's keep this good track going forward. I personally feel that UPM possibly is a silver customer currently going to be upgraded towards the gold customer status. So we are on the right track. We would need to have even more agility and more clock speed in the changes that we are doing.
All right, that was Jyrki, and personally I think they have a platinum card, but he's a little bit modest about the service levels we are giving, I'm sure. But I showed you this last year, and it all starts with the customer. We need to be the most customer-oriented company in this industry, because it's a competitive arena, and if we can handle those top 50 who are $1 billion for us, we have $1 billion to run day in, day out. So we have really put focus a lot to the customers, and even I try to do it as much as I can, because without the customers we don't need the assets, and we have no assets to sweat without the orders. The rest I will not go through, but customer satisfaction has improved dramatically. We have been able to manage our fixed costs, so in local currencies, the first half of this year, our costs were same or lower than last year on the same time. So basically what we have done in the business overheads, we have killed the inflation, which is not an easy task to do, but you know it's hard work, and I believe that hard work always pays off. Few words about the market. I think it's pretty self-evident to yourselves that you know Asia will be the growth pocket of board and paper and tissue, and then when it comes to pulping, it's the northern hemisphere of Europe, and then it's going to be the Latin America where the fiber is, and that's where the investment is taking place. And then the Western world, North America and Europe is flattish at best, and bear in mind that in the next 5-10 years, APAC as a market alone will be bigger than North America and Europe together. So I've always semi-joking that if you want to grow, go east and go fast. Saying that, we have more than doubled our turnover in APAC in 2.5 years. And this is just a summary slide that in EMEA we are, I could say, undisputed leader, but of course leader has to work hard to stay where we are. So we are fighting for that market. That's our home soil, and we really base it on an exceptional customer experience. North America, we used to be 4 or 5. Now I think we're 2 or 3. It's very competitive, and we want to transform more from the printing and writing towards the board. APAC number 1, but our market share is only 10%. It's a huge market, so we are looking for growth pockets, and we can still squeeze out of the existing assets and try to get it to the full utilization. South America, heavy on a bleaching part with 2 chemical islands, one in Clubin, one in Fray Bentos, but we do also serve the paper accounts from our factories there, but we are smallish on that market. I think this one I can say quickly that Jari already told this, but it's been a great deal. We have had a good assets in APAC and a lot of good competitive people, because this is a people business, and we have gained a lot of know-how and sort of a contacts in Asia via this acquisition. So it's been fantastic, and the synergies are coming as we have promised or even more. APAC, I think I more or less said this already, that we are around 200 million now. That equals to 10% market share on the market. Want to grow more and sort of looking for opportunities to utilize the product range we have by selling what we call the TCMs, the Total Chemistry Management. So we are not only selling a product to a customer, we want to sell everything on that board line or paper line and take the responsibility of the chemical process inside the customer's production process. And then we put our people on the ground and we measure it with our chemical nets and devices. So we believe that the package and service is the strength. Well, this one I think we covered more or less, and I think this might be my last slide, but Joutseno, as Jari already said, we are in a unique position to ramp it up with the full order book. So basically we have sold the capacity before it even started. And that's a great thing to have. And then the project went to the budget, and technically it has been going okay, and it's been ahead of the schedule. So basically it's a perfect implementation of a strategic project, and also the way we have sold the capacity to ramp it up with full speed. So nothing sort of a super new, but you know, steady progress, more happy customers, maybe a little bit bigger share of the wallet we have, and sort of a good platform to build on the future growth. I think that was my last slide. Happy to answer any questions if I can.
Thank you, Kim. Let's take a couple of questions to Kim here.
Yeah, thank you. Christian Veitz, Kepler Cheuvreux. Can you tell us what the split in terms of chemical uses between new paper and recycling paper?
Can you repeat the question?
Can you tell us what the split is in terms of chemical markets, in terms of recycling paper and new paper, fresh paper?
Oh, you mean like virgin fiber
Yes,
and recyclable? Yes. Well, I can't even tell that, to be honest. We don't know it. There will be the paper companies who know it. But what we do know is that the recycled fiber, there's less and less available. So eventually the market is definitely turning towards virgin fiber, and hopefully for planted virgin fiber, not like a rainforest. And picking on that point, we are working on a project where we try to reduce the weight of a board in order to save fiber and sort of be more sustainable in a way, and that's looking pretty good, but I'm sure we're going to talk about it later. But honestly, I don't know the ratios.
Okay.
Sorry for that.
Next question. There are no further questions, so we will continue the discussion then in the breakout session later in the day.
All right, thank you.
Let's move on. Next, Antti Salminen. Antti used to be the head of municipal and industrial segment, and Antti took the profitability of that segment to around 15%. Now he has this combined municipal and industrial plus oil and mining segment called industry and water. And Antti, hopefully you will do the trick again to take that segment to 15% operative EBITDA. Antti, please go ahead.
Thank you. Yes, so it seems that when you achieve something, the world brings new challenges onto your plate, and then you know we need to start from the beginning. So that's what we're working on. The new industry and water segment, I will explain very briefly, you know, some of the kind of the basic structure and business we're in, and what we're planning to do, and the kind of synergies that we try to create with the reorganization. But let's start with kind of the few key points regarding the business. So when we merged the two segments, we did not exit any of the existing kind of end customer uses. So it's really kind of, we still have the same foundation of businesses, and the kind of underlying base business in oil and gas, in water treatment, both industrial and municipal water treatment, is a healthy business. There are mega trends that are supporting all parts of this business, supporting the growth, and especially the kind of big exposure to the mature market and water treatment is bringing some stability. We all understand that oil and gas markets are more volatile, and then we have the very stable part of the water treatment. So these two parts are kind of balancing each other nicely off and building a segment where we have the growth engine, the growth opportunities in the oil and gas, and then we have the stable base business in the water treatment. The new structure creates good growth and efficiency opportunities. Of course, merging the two segments alone brings some cost synergies, but also the global reach that we had in the legacy municipal and industrial business is giving us good opportunities in the oil and gas part to reach out to those areas in the world where we have not been that active in that business previously. And then the third key point is the innovation. So all the businesses where we are, the future growth will be driven by innovation, and not necessarily chemical innovation. Chemical innovation plays a part there. We have good, nice stories, especially in oil and gas area, where we have developed new chemistries to support special type of business with the customers in co-development projects. But many of the innovation will be coming, especially in the water treatment area, from digitalization, adding service component into what we provide to customers, and creating this advanced water treatment type of services. And I will have an example later on that. This is the new segment in a snapshot. So basically, in the selected business areas where we are market leader. So we are market leader in the North American and European water treatment chemicals, and we are kind of a market leader in the selected niches or pockets of the oil and gas market. Not as the chemicals for the oil and gas markets as a whole, but those selected strategic arenas where we have selected to play, we aim to be there the leader. You see the historical development, the kind of combined numbers of the two segments, and I think what is important there is that you clearly see the growth, organic growth, to which we have returned now after the drastic drop that Jari mentioned regarding the oil and gas business, which is impacting the whole numbers. As I mentioned, the legacy municipal and industrial business is very steady, growing 1% to 2%, 3% max a year. So basically then the ups and downs of oil and gas business are then making the big shifts in the growth numbers, and I'm really happy to report that the 2 quarters of this year have been a nice return to relatively fast organic growth. The oil and gas business represents roughly 15% of the new segment. 70% of the segment business we classify broadly as water treatment, and then we have 15%, which is the other uses into where we can use the same chemistries that we are anyway producing. So this is kind of a, in a sense, non-strategic part of the business. In terms of products, it's quite a nice even split of inorganic coagulants, polymers, and then different types of other chemistries that we produce. And in our case, again, EMEA is a bit more than half of the business, Americas 40%, and big part of the Americas is actually a very nice split between the oil and gas business and the water treatment business, whereas EMEA is more focused on the water treatment business. APAC is only 5% of our business portfolio, but it's seen as a clear growth platform, but we're starting from very, very small base there. And our market share in the water treatment in APAC is really, really small at the moment. To maybe answer a bit more the question that was previously asked from Jari regarding the regulations in China, we clearly see, as Jari mentioned, that the focus of the central government is moving more to water pollution and prevention of that, and the tightening regulation will play into our advantage there. Not only from the water treatment regulations, but even more so from the perspective of the other environmental regulations that the government is putting in place in terms of industry. Because that is kind of creating an advantage for us using Western technology, high standard products, high quality products, as opposed to many of the kind of local competition, which now, according to the new regulations, in some cases even need to close down their plants because they're not meeting the new environmental permit requirements of the authorities. If you then look at briefly, as I mentioned, 2017 is a year of returning to growth. The profitability numbers you clearly see there in the beginning part of this year, the headwinds from the raw materials, especially the polymer-related raw materials. And now looking at the market, raw material market at this point, it looks more positive than negative, but there are, of course, always some uncertainties around that, so we can't really fully count on that. And of course, the Irmas and Harveys of this world are not helping there. But overall, we've been quite successful in implementing price increases for our products, both in the water treatment area and in oil and gas. Actually, several consecutive price increase rounds. So that comes always a bit after the raw material impact, but we clearly see that the kind of price impact has been turning to positive now during the last quarter or so. So we're actually getting really nicely back on track there, and I have a good confidence on kind of as the challenge was thrown to start kind of bringing the combined segment profitability back to those numbers that we saw earlier with the M&I segment. The clear growth opportunities for us, as mentioned, are in oil and gas. They're in the advanced water treatment area of the water business, and then the APAC, where our biggest challenge today is that we don't have own production assets in there for the water chemicals. So we're bringing in those from Europe and North America. But we've been successful even with the imported products, as clearly our position is the high quality kind of top tier player there for those applications that require special competence and knowledge and products. The new structure, as mentioned, creates both growth opportunities and efficiency opportunities. So as I mentioned, the legacy M&I business, we operate it everywhere else except for South America. So that brings a platform. We have salespeople, we have application people everywhere, whereas the oil and gas was, for instance, not strategically focusing to APAC previously. So there are opportunities there that are created by the new structure. Similarly, a few years back, the M&I walked away from South America and we sold our assets there. So we also didn't have a sales force there, whereas the legacy oil and mining segment has a strong presence in South America. So that again gives us opportunities there for the water treatment, not building new assets to replace those that we sold, but really kind of we have the sales force, we have the expertise there, and we can play on that market with the products brought in from North America. Then we are combining now the Kemira level polymer related expertise and competence into this one segment. So all the product manager, business development people, everybody who's experts on the polymers is now under one umbrella in this segment. So we create a stronger competence base to support the polymer-based business there. And then there's a lot of water opportunities in oil and gas and mining businesses, and we have a lot of expertise on that in the legacy M&I business. So that's another synergy opportunity there to go deeper into the water treatment in the oil and gas and mining industries. Of course, the structural changes that we've done, they are planned to make the decision-making faster in the segment, bringing the operations closer to the strategic segment-level decision-making. Where the new structure is more focused on global scale-up of new innovations, so driving the new business development initiatives globally, not regionally. So that's another growth opportunity for us that is enabled by the new segment structure. And then, of course, there are the direct cost synergies from combining two segments, and a significant part of what we have communicated as the reorganization cost savings, significant part of that number comes from the new industry and water segment structure. When talking about innovation, as I mentioned, we have a well-defined innovation portfolio for the segment where we are targeting to those areas where we see good growth opportunities. If you look at the strategic initiatives that we have launched during the past 2-3 years and the revenue growth that we are generating from those, so there's a very, very good, nice growth there, and we are actually kind of getting the results of those strategic initiatives. And when you look at the different innovation arenas, so these are the kind of main growth driving innovation arenas, and the numbers, they refer to different active new product development projects that we have on those domains. So there's a lot of activity ongoing in the enhanced oil recovery area, as well as the solid liquid separation, which is many of those are related to sludge treatment in the wastewater operations and so forth. So clearly, the innovation will be one of the key drivers of the future growth and profitability, and already today, roughly 12% of the industry and water segment come from innovation sales. And this is just a brief case example of the kind of non-chemical related innovation and advanced water treatment to remind us all that, even if, as Jari said earlier, the service will not be dominant part of our business anytime soon, but the kind of services combining information technology and chemistry will be important driver for additional growth. And kind of in B2B environment, people always ask that, how do you make money then on this? It's easy to see the opportunities that technology creates, but how do you make money out of that? And this is just a kind of simplified example of what it means in practice. When there is a wastewater treatment plant and the sludge, which is kind of the residual of the operation, big part, more than half of the cost structure of that operator comes from the disposal cost of the sludge. And chemicals are a small part of that. Now, if with the technology and we have proven this, with the technology and our chemistry, we can help them to significantly increase the tri-solids content in the sludge. It means that they save in their energy, in their transportation, in their disposal costs, and part of that additional saving and value for the customer we can capture as kind of a performance-based service fee for that kind of a service. So, to summarize, when we created the industry and water segment, I think we created a stronger platform for profitable growth with strengthened business in the growing market areas, which are our strategic focus markets, a structure that helps us to play in these markets, to make faster decisions and get to the results faster, and innovation is a key driver for future growth and profitability, and Pedro will later on, after lunch, talk more about the oil and gas and how we have returned to growth and how we have actually returned also to improve profits in that business. Thank you.
Excellent. Let's take a couple of questions to Antti.
Patrick Lambert, Raymond James. A very quick question on Chem Connect. Which segments, which end use do you see the most interested into getting into those type of solutions? That's question one. And question two, very quickly, the 15% we have no clue about. How should we think about modeling it?
Good. So first, the Chem Connect. The nice thing about Chem Connect is that we've actually developed a communication platform that can be used in all of our businesses. And we have live successful examples in paper business, in municipal water treatment, where we have not been that active this far has been the oil and gas part of the business, but now with the new structure we are very actively looking at opportunities in the oil and gas business as well. But basically any industrial process dealing in a kind of liquid phase can be kind of target for that. And anywhere where we have the chemical expertise, we can combine that with the Chem Connect measuring devices, and we have the process knowledge, so those are good opportunities for that.
And the gain on cost is about the same by segment?
It depends on an application. So sometimes it's a gain in cost, and that's a typical case to help the customer save costs. Sometimes it's about the end product quality, improving that. Paper is a good example where we are actually with these Chem Connect devices understanding better what happens at the paper machine, and that can help improve the quality of the end product, for instance, or runnability.
Next question.
We had the other part, which is
sorry.
the 15% that is difficult to model, and it will remain difficult to model because, as I mentioned, the 15% of other, these are really the kind of, I'll just give some examples of that. So the inorganic coagulants that we produce for water treatment, exactly the same formulation, the same product can be used as an ingredient in concrete manufacturing, or it can be used in the fire retardant manufacturing, either as an ingredient or production aid. So it's really widespread and different dynamics driving for those different application areas. So I would not even try to model that. Margin-wise, it's in line with what we are doing, and some of those actually are very kind of a relatively high margin, because especially in a situation where we need to choose whether we do something in our strategic customer base or whether we do something somewhere else, it always has to be significantly higher profit if we choose that one.
Good.
Ben Gorman, UBS. Just on the China water treatment point that you were making, how big specifically is China of your sales? And then I guess how big is your market share? Who are your main competitors?
Yeah.
Sort of first part. And then in terms of your logistical challenges there, you talk about having to do a lot of importing.
Yeah.
How much do you need to put down in the region?
Well, you saw it from the numbers. China, I mean, if you just do the math from that, it's roughly 25 million of the sales. With that, in the water treatment, we have market share which is below 1% in China. So there's a lot of opportunities to catch there. In terms of the challenges of importing the product, we operate mostly in the main cities, which are, I mean, Chinese infrastructure is actually very well developed in there, so that the logistics as such is not bringing us as operative challenges. Of course, it's a cost element, but as mentioned, what has been kind of capping our growth there has been this, that because of the higher cost that we are importing the product, we are limited to those high tier, kind of top tier applications where the quality customer is willing to pay the higher price for the quality. So at some point, kind of if you want to go really big time into those opportunities, then of course we would need to have a one way or the other production capability in there, which we actually are already to some degree doing, because the Nanjing plant, which is primarily paper chemical plant, we're producing there some water treatment chemistries as well and using that already.
Couple of questions there behind.
Thanks, Robin Santavirta, Carnegie. Could you talk about the oil and gas market growth outlook now for H2 and 2018? You have super strong growth in H1, sort of strong recovery in sales. how is the underlying market now developing with the rig counts in North America, and what should we expect? What kind of growth for the second half of the year and 2018 would be good to expect?
Good. Pedro will be addressing those questions after lunch in more detail. What I can only say here, in order not to kind of use his time, so basically it looks very positive at the moment. But he will address that in more detail after the lunch.
Okay, thanks. And shortly on the bringing the two segments together, now is the cost saving 15 to 20 million, or is this sort of because you were talking about synergies and other opportunities to gain business, so that's on top of the 15 to 20?
Yes, we have communicated that with the restructuring overall on Kemira level, we aim at 15 to 20 million cost savings. As Jari mentioned, the run rate is at the end of this year there, and it is exactly in that range, but that's cost synergies. So all the other stuff that I talked about is kind of on top of those cost savings.
Thank you very much.
Okay, let's take the next question here from the iPad. There's a question: what's the pipeline like for municipal water treatment contracts in each region, and what are the pricing dynamics for contracts in Asia?
Well, I would need the rest of the day to answer that kind of conclusively, but the municipal water treatment business in North America and in Europe is typically a kind of a public bid type of business, and the contract durations are mostly 1 and 2 year contracts, in some cases 3-year contracts, but typically 1 or 2 year customer contracts. Of course, Asia is less developed in that respect, so it's kind of, there's more variety into different types of contract types there. But the main Chinese cities, for instance, are pretty much following the Western practice in terms of how they contract out the chemicals.
Let's take a next one here. How far are you being fully utilized in industry and water? And after merging the separate divisions, have you decided to direct some of the capacity into other end markets in order to boost capacity utilization rates?
Yeah. We're actually, at the moment, very well utilized in our asset base. And we have to remember that the polymer assets, which Jari mentioned, that are serving all the businesses, pulp and paper, and all parts of the industry and water business, we're already utilizing that capacity to serve all of our businesses. So that's normal life for us. Same goes for the coagulant, inorganic coagulant plants. So those are predominantly water treatment chemicals, but we use the same capacity to support the pulp and paper business as well. So that we are already doing. If you look at the polymer capacity, it's very well utilized today. If you look at the coagulant, it's well utilized. So there's still room to grow there, but capacity utilization by no means is a problem for us today.
Good. There are a couple of other questions to our CEO and CFO, and I will take those when we have the joint Q&A to our CEO and CFO. So don't worry, your questions will be answered later during the day. Question here in the room?
It's Nick Longhurst here from Marathon. Did I understand you right? You said that you shut down in Latin America a while ago.
Yeah.
In water treatment. Why would you?
Yeah, we divested the assets.
Because you divested it.
Yes.
But then you're saying now, well, basically you've got a sales force from the other divisions,
Yeah.
and so are you now selling everything through everyone? Is that what you're doing across the board? So
we're not yet selling everything through everyone, and there's certain part of the sales force is kind of experts and competent on certain parts of the customer businesses. But what this now gives us is that we have the platform, and we have started to look at these opportunities now. So we have existing oil and mining sales force in South America. So basically, there are some good water treatment opportunities that these people can tackle there with the products produced in North America.
I guess I always think of this as a very technical selling type. It's not like double glazing, right? Yeah. It's a very technical sales, I think, anyway. And yeah. I was just surprised that you said, "Oh, well, these people can sell that." It feels like it was sort of, we just changed the nameplate and. No,
it's not like that. But there's again, we can utilize that opportunity to a certain degree. But yes, I mean, then if we really kind of full-blown go there, we need to start developing back those competencies as well. So.
Very good. There are no further questions, so let's have the lunch break now, and we will continue in this room sharply 13:20, 20 past 1. Thank you. All right, welcome back from the break. We will continue with Pedro Materán from Houston. Pedro joined us back in 2006 when we acquired Scitech. Pedro will talk about the exciting journey in oil and gas and how the future looks like. Pedro, please go ahead.
All right. Thank you, Olli. Thank you, everybody, for being here. Really excited to come today and talk about our oil and gas business in Kemira. We're going to go from who we are, what we have done recently, and more importantly, what we're going to be doing and focusing in the future. The main message that we want to put out there for all of you guys is that, number one, we're back on growth, and number two, we have clear targets to continue to grow further in this business. First, we're a small part of Kemira. In terms of revenue, we're only 7% of the total revenue in Kemira, but we have a huge opportunity in front of us, something like 2.5 billion euros opportunity in the market that we're playing today. Our group is a small group. We only have around 30 commercial people around the world, but these are one of the best. Number one, they're highly capable. Number two, they're highly motivated. And more importantly, they focus on a couple of key accounts. We have around 200 accounts globally, and this comes from operators in the oil and gas industry all the way to service companies. We focus on a couple of areas in oil and gas. We focus in the areas that, number one, we see that are sizable. Number two, that we believe they have potential for growth. But more importantly, in the areas that we can win. When you look into the geographical areas, number one, we have 75% of our business in the Americas. Why? That's where the majority of the opportunity is for any chemical company that works in oil and gas. Secondly, if you look, for example, into the drilling market, drilling rigs, 52% of the drilling rigs in the world are located in North America. So naturally, a place to be, a place to compete. Secondly, when you look into our specialty chemicals, we focus on we're strong. We're strong on polymers. We're the second biggest producer in the world. And obviously, we got to leverage that capability into the oil and gas market. So that's why we have the majority of our focus on the polymer, synthetic polymer side. The third part is in terms of applications. We focus on the areas that are highly intensive in terms of use of water. When you look into the whole spectrum on the oil and gas market, from production all the way to a refinery, when you go to the upstream market, that's the area where the majority of the water is being used. Just to give you an example, the world produces around 98 million barrels of oil every day. And you know how much water we produce associated with that? 3 times that. So 300 million of barrels of water are being produced when you extract this oil from underground. So a huge opportunity for us, all that in upstream, and that's why we put all our efforts on that area. One thing to remember, now under the Industry and Water group, we have all the capabilities and the knowledge from the water technologies, and we're mixing that with the oil area when many of the applications that you will see in a minute are related to water. Going into what we had done most recently, obviously everybody is aware of the downturn that we had in the market a year or two back, the biggest in history. The team has shown how resilient they are. Number one, surviving during this downturn, but number two, and more importantly, is developing the business on new areas while the market was going through this downturn. That's how we got to 47% growth in the first half of the year versus previous year. And if you look into the oil and gas price, it had been in a market that had been relatively stable. So from that perspective, the team had done an outstanding job on trying to continue to develop and diversify the business, especially into our areas. the chemical EOR, and in the oil sand area that we'll explain in more detail in a minute. The three main differentiating points that we have are related to bringing increases process efficiency, secondly, reduction in cost, and then third is managing the environmental concerns or issues that certain customers have. But more importantly, the umbrella, how we do all this, is related to our innovation. Just to give you an idea, more than 10% of our revenue today in oil and gas is coming from products that we have developed in recent years. With that, let's take a look a little bit about all the changes, right? Antti was talking about the new organization. So obviously oil and gas is under the industry and water umbrella. But what this is bringing is three key points for us. Number one, we're moving from managing the business on a regional base into a global way. And the important part of that is that that's what our customers are doing. So we're getting more aligned with what the customers are doing. Number two, we are heavily weighted on the upstream applications, basically how you reach the oil. And we're moving now slowly but sure from upstream to midstream. What that means? That means that we're diversifying, obviously, but more importantly, we're reducing our dependency on this oil price going up and down. If you continue to move downstream in the value chain of oil and gas, you get a more stable business. So strategically, that's an important move that we are doing to have a more stable business. How we're doing this? We are setting up two units. One unit called Oil Field Chemicals, and the second one, Oil Field Services. Both of them having a significant opportunity, more than €1 billion in market opportunity for Kemira, but they are totally separate in terms of how they approach the market, how they operate. One, mostly focusing on the upstream, the normal downstream, the drilling, cementing, shale. The second one, mostly on oil sands production and chemical EOR. Then when we look into the type of customers that we're working on, Oilfield Chemicals is all about service companies, the companies that add value to our chemistries. And what our offerings to them is pretty simple. It's our manufacturing and innovation capabilities. When you look into the oilfield services area, it's totally different because this is all about dealing with operators. A more important thing, what we are offering there is not the chemicals, is a total package solution for what their needs could be. We expect to continue to grow in a moderate way in the oil field chemicals, but then in the oil field services, get a little bit more of a strong growth there. Looking into the first area of focus that we have, this is the base of what we have been doing. It's the first one we started to diversify a couple of years back. It's called shale. And the link of shale with what Kemira does is that it's heavily water intensive. When you look into, for example, what they do when they do this process, which is basically injecting water down the formation, get into this formation and literally breaking it or fracking it. You have heard about fracking, I'm sure. So basically when you do that process, you are helping to produce either natural gas or oil faster and easier. So that's the water connection, right? So we have as an example, in one of these applications, you may be using 5 to 10 million gallons of water in one of those applications. What that represents for us, that they use chemicals associated with it, and it's around only 1% of this volume of water. And from that, just a small portion is related to our special chemicals. But even when I'm going from a big number to smaller numbers, you can see that only in polymers, the market potential for us on this application is more than 200 million euros. We are well positioned on this area. We have around 30% of the market in North America. And this is an area that you have heard a lot in the past when the downturn, and it was supposed to be one of the areas that will either go down or even disappear in terms of an opportunity. Well, that's not the fact. That's not what happened. It's not the case because of three things. Number one, a consolidation in the market. Number two, more efficiencies and one on each of these processes. And number three, that all these companies are now focusing on the areas that they can generate more cash, even at that $20 a barrel price. So we will continue to develop this area. Obviously, recently we have more than double our business in the first half of the year. And then when you look into how we continue to do this, is based only on one main factor, is on our innovation capabilities. We bring technology to the market. Every 6 months, we bring a new product to the market. And that's what keeps us ahead of everybody else. Now looking into chemical EOR. Many of you have heard about this before. You understand clearly why Kemira is on this area. Again, significant amount of water being pumped down the hole, basically to, in a way, push additional oil out of the reservoir. So that's the concept. But at the end of the day, is significant amount of water that is being used that have some additive, in this case, chemicals. And for us, that means polymers. And on the polymer side, just the market that is available for us these days is around 500 million. The big difference between chemical EOR and shale is the timing. Shale, you can get in, can get out really fast. Chemical EOR, it takes a long time to get in. It also takes a long time to get out. So we got to be sometimes patient with this application. But the important part, this application will continue to grow, because as much as people think that there is enough oil out there, well, there is enough oil, but maybe not the easy one. And one of the easiest ways to extract oil these days from where you know where it is waiting to be pumped out, is basically using chemical EOR. We have been changing our offering here, moving from only the chemical side to all the way to the total solutions, meaning we offer equipment, chemicals, and the service associated with it. And we have high expectations on this business. Hopefully, 5 years from now, we're going to be targeting to be at around 100 million on this area. Getting into the newest kit here, which is the oil sands. Again, another process that uses significant amount of water to process or produce oil. Just to give you a reference, Canada produces around, in this application, more than 2 million barrels of oil a day. And you need 3 barrels of water to produce that oil. So 6 million barrels a day of water that you need to use, you need to treat, you need to manage in some way. And that's when Kemira comes and play a role. We see a significant potential there. We have the opportunity to continue to grow there, especially on the environmental side, meaning the tailings that are coming out of this process. That's something that no matter what happened with that industry, it needs to be treated. And that's where Kemira plays a role. We have been progressing pretty nicely in the last 2 years. We are happy to report that we're around, at the beginning of this year, we grew from 0 to 20 million euros in revenue in that area. And we have exciting things coming our way. As an example, we just recently signed a contract to one-time item in terms of equipment that we're offering to one of our big customers there. So, and this is multi-dollar agreement. So it's an evolution. We expect to continue to grow in this area, especially focus on the big operators on this industry. Looking into a little bit more in the short term, we expect to continue to strengthen our position. We expect to continue our growth trend. We also will be putting additional efforts on increasing our profitability. It has been a challenge for everybody in the industry in recent years, but now moving from red to black. And we're going to be adapting to that as well, meaning improving our margins there. We don't have a lot of people. We don't expect to have a lot of people either, but we're going to continue to hire selectively and, more importantly, continue to develop our people. And then last but not least, our main differentiator is related to innovation. So in the coming months, we're going to bring to the market a couple of new products. We expect good results from that. And then also we have a couple of key field trials that most likely will be the base for a couple of big projects in the future. As a summary, I think that we feel that we are well positioned to continue to grow in the selected niches areas that we have selected. We expect to continue to move from the first phase, which was between 2009 to 2017, which was basically grow a little bit, prove the concept, and that was under the umbrella of oil and mining. And now together, or under the umbrella as well of industry and water, we expect to move forward. Again, the main differentiator will be related to our capability for innovate, and do that in three main areas: shale, chemical EOR, and oil sands. And hopefully continue to grow and help our customers to extract more. Thank you.
Thank you, Pedro. Let's take a couple of questions to Pedro.
Ben Gorman, UBS. In terms of the key competitors in CEOR and oil sands, are they basically the same people? And in terms of these businesses being margin accretive, if you've got the sort of same competitors, what makes it a higher margin industry? Higher barriers to entry in some way, or adding value to, you know?
Yeah. Thank you. Yeah. If we were only talking about polymer, for example, yes, in terms of competitors, they are similar. They are the same, actually. But the key here is how we differentiate as a company. If you compare Kemira with the others, our biggest tool here is our capability to adapt our polymers to their new solutions. These are no static applications. It starts static, but then with time, you need to adjust your chemistry, higher temperature, higher pressure, salinity, and all the things. So on those areas, you need to continue reinvent the wheel in a way, and that's what we do in Kemira, and we do it really well.
Panu Laitamäki from Danske Bank. I have a question on this shale polymer market growth of double digits. So what is driving this? Is it that shale fracking volumes are growing, and how that relates to the rig count, where the increase has kind of stopped in the past 2 months or so? And or is it like higher penetration of your products in the fracking process, which a couple of years ago was estimated to be 60-70%? So is there still room to grow?
Yeah, absolutely. No, thank you. I think that starting with the what have changed, right? Number one, well, it's obvious we have a little bit of a growth in the market, right, in terms of demand in the last 12 months. So that's one thing that is obvious, right? The second thing that is not obvious is that the operations have changed. They have become more efficient in many ways, and luckily enough, these efficiencies are linked to many of our products. So when they get more efficient, which is good to reduce the overall cost, they're using more of our products. And then the third part, which relates to additional growth, is that we have been able to position these new products that we have more competitive versus other alternatives that are in the market. I think that you have heard before about the war, for example. So all the factors are helping us in a way to grow this business in recent years.
Good. Are there further questions here in the room? If not, let's move on. Thank you, Pedro.
Thanks.
And we will continue with Thierry Blumet. Thierry is our expert about sourcing. He has done a long and successful career in sourcing. He joined us in 2013, and prior to that, Thierry worked at PPG and DuPont. Thierry, please go ahead.
Thank you, Olli. So, glad to have the opportunity to present to you how sourcing is contributing to Kemira's business performance. Together with my team, we are responsible of 1 billion euro of direct material. It's a lot of money. So the way it is managed requires high strategic intent to make sure that we support the business in the intended manner. Our mission is first to make sure that we keep Kemira competitive. That's essential. But we also drive high performance from our suppliers and in a sustainable manner that is connected to managing risk. I mentioned €1 billion. You can make your maths on the graph. About 65% of that is directly raw materials, and I'm going to focus on that part today to explain to you why we have to have a strategic way to manage it and how we do it. Only 30% of that raw material spend is connected to oil. The rest is either mineral, connected to the mining industry, or vegetal, we talk about harvesting natural resources, or further processed chemicals. It is true that when you look at the top of our raw materials, half of them have a strong connection to the oil and the petrochemical value chain. The others, they belong to the other categories I mentioned. You will see that in the coming slides why this KPI that is on the left side is of essential importance. We have gone a long way already in improving and reducing our dependency on sole or single source of supply, up to the point that most likely by the end of the year we should be even getting below 8% of our raw material spend that will be in this peculiar situation. The second thing that we can highlight as one of our KPIs is we have been working hard to improve overall Kemira's working capital by extending the supplier's payment term from the low 30 days to most likely we are going to hit the number of 50 days by the end of this year. These are examples of multiple focused KPIs that are driving our action. One of the fundamental characteristics of the business and how we can improve our business segments to increase their profitability is managing two environments. One that is volume related, and I will explain to you more in detail what it means, and one is what is price related, that have different dynamics that need to be mapped out and strategized. If we focus first on the volume aspect, it's all about supply-demand dynamics. And I don't want to give a lecture of business economics. I just want to illustrate how important it is in the industry we work in. We have two different time horizons where we have potential very significant shift in supply and demand balance. One is the long term. It means that the chemical industry goes through cycles of downturn, no appetite for reinvestment to boost capacity expansion until there is enough visibility on demand. And then demand starts to pick up, and then there is reinvestment economics that are starting to be there, and people are reinvesting. And we go through this cycle of overcapacity and tightness. And we have to navigate in those cycles. They are inherent to the industry, and we have to anticipate as much as possible those. The other aspect is more short-term. We have variation of supply-demand that are connected to all kinds of short-term situations. Could be mechanical failures, could be natural events like we have been mentioning today, the Harvey as an example. And those could have massive effect on the availability of the raw materials we buy. So how do we manage that? First of all, Kemira mostly act under contract. We do very little spot business. The second thing is that we are carefully studying the timing and the length of our contracts to make sure that they are adapted to those cycles. And back to the first KPI that I shown you, multiple sources is the rule of the game. Pricing. We talk about an industry, and especially the oil-related part of our raw material portfolio. There is heavy price dynamics. It's very volatile. You have here on the graph an example of not a long-term view. You can see already the swings that we see in our industry. I illustrate here an example. We start from oil, that has gone up 68% over a certain time horizon. This oil is one of the primary. You crack it, and you produce propylene. You have already a dilution of the effect of the price volatility. And then you go down one step downstream in the chain. You use propylene, 1:1.1 ratio to manufacture acrylonitrile. Then you have another dilution of the effect. And then you use the acrylonitrile to manufacture a polymer that Kemira is supplying to its customers. And then you have another level of dilution. The understanding of those steps is essential to make sure that, first, there is a fair value offering by the suppliers, and second, we are having a close understanding of the margins of the upstream part of the value chain. How do we do that? We have a value chain cost modeling. For most of the important raw materials, we have absolute precision on those elements. And together with the business, and that's the essential part, we monitor, we react, or we proactively manage those cycles. And for sure, sometimes they are pretty dynamic and of big order of magnitude. So it's essential. It's a big contribution to the performance of the corporation, of the business segments, and how are we moving forward to even further improve on what we are doing. We continue to reduce the exposure. The target is to go below 5%. We will remain with some chemicals that are only produced in the world by one company, but we should limit that as much as possible. We work with preferred suppliers as much as possible because that's giving us a proper cover versus what we need and what the risk we may have. And with key suppliers, we have launched a program that is called Vendor Value Program. No rocket science, but it's meant to make sure that the suppliers are helping us through all kinds of additional value proposition that they can formulate. It could be new product introduction ahead of the rest of the market. It could be different supply chain setups that we can work together to improve our cost. And we have precise numbers and targets in savings that can be associated to those programs. And continue to do that in a very efficient manner with our team so that we can grow together with the business with limited resources, doing the best that is needed. That's how sourcing helps improve the performance of Kemira through the management of this 1 billion euro of direct materials. Thank you.
Thank you, Thierry. Questions?
I was just wondering how you managed to contract most of your chemical purchases versus spot? Because to my knowledge, there's very limited contract, at least official contracts in place. So how do you do that? Can you explain that a little bit more?
Sure. The first thing is that you set the stage properly with the people you interact with, meaning the suppliers. It's a give and take. And the outcome of that is that you need to be appealing enough as a business in terms of growth profile, in terms of importance for their portfolio. And if you're successful in raising the attention and having clarity on the give and take for getting the business, often you end up being able to formulate it under a contract. And most of those contracts are under Kemira's terms and conditions that are pretty straightforward, clear, and giving also for the supplier a very clean view on how things should be handled, what are the performance that are expected, and what is also our level of commitment.
Good. Next question.
Romy Santoilta, Carnegie. You said spot, no spot, but contracts. So what's the average length of the contracts in key raw materials? And then related to that, how is that linked with the sales prices and the changes in the sales prices?
Okay, so the exact number to your question is 2.3 years. Sorry for the precision. It looks like an accountant, but this is something that is of importance for us, so we track it. So it's 2.3 years on average. And the way the contracts for the key raw metals are formulated, they could be either a fixed price for the whole period of the contracting period, or they could be all kinds of different indexation that are reflecting the value chain cost structure. So, for example, it's not untypical that the acrylonitrile, as an example, the one I shown, you have, as part of the price, some indexation to the upstream feedstocks, such as propylene, reflected into the pricing mechanism. And that's also a way to control the margin, because you have the formula and you fix the adder, which is the margin and the fixed cost of the supplier.
Is the 2.3 year, I guess that's a frame agreement on volume or something like that, but I was just, how often do you check or how often are you allowed to change, or the seller of the raw material allowed to change the raw material price? That cannot be every 2.3 years. That must be much often. So what I'm after is that the margin impact if raw materials go up, or I can see that ethylene and propylene prices, for example, at the moment are surging in the US. When will that be visible for you guys? And then when will you be able to raise your sales prices? So these dynamics.
Fair enough as a question. So back to the distinguish between the fixed price. They could be fixed price for 3 years on certain product. We have some of those contracts. Or they could be quarterly price for the most dynamic ones. Why? Because we want to make sure that we are in sync with the market and the cost structure, and as well as also the suppliers will never accept to take more than a quarter or 6 months or a year, whatever the chemicals engagement, because also they don't have the visibility. So when they are on a quarterly index formula, for example, for sure, the price will vary according to the cost components on a quarterly basis. And that's the agility I was referring to about the way we manage that internally within Kemira and together with the business to make sure that we are managing it in a way to protect and enhance our gross margin.
Good, thanks.
Welcome.
Okay, let's then take a question here from Johannes Krasberger. Do you think Kemira is somehow in a worse position compared to the blue chips in terms of sourcing, or is it actually so that the company size does not matter that much here?
Well, we need to be humble with those kinds of questions. The ultimate proof to answer the question is when you make an acquisition and then you compare facts and then you position yourself. whatever the company's respective size was, you can get to the ultimate comparison that say, for a given raw material, where are you buying it on average? Less expensive or more expensive than the company you acquired. So this is the ultimate proof. The recent acquisition we have made in Kemira's history have demonstrated that there were very, very few number of raw materials that the company we acquired had a better pricing than what we had. So that's one. Okay, it's on a limited scope because this is what Kemira acquired, so it's maybe not big blue chip, and we didn't acquire BASF for sure. So, so how do we compare with the bigger companies? Sometimes size matter for sure. We cannot deny that it has certain effect. So somebody buying 10 times bigger quantities than we do might get better price and terms, but also sometimes it's not about the size, and it's about being the preferred customer of choice for the supplier, meaning reliable, contracted, predictable, and sustainable customer and outlet for their units and their business. And that's where Kemira certainly has maybe a good fit for many suppliers, and sometimes coming at par with much bigger companies in terms of accessing those raw materials at competitive cost.
Thank you. Theory is also available during the breakout sessions.
As much as
let's move on. Our next speaker is our CFO, Petri Castrén. Petri is known to many of you, so Petri, please go ahead.
Good afternoon from my part as well. So I will close today, and I'll try to summarize actually in a couple of the key points that have been raised already in questions to Thierry and Jari as well. And those are primarily on what's the correlation between variable costs and the sales prices. Let's look at the trends and think of whether that's a prediction of the future. And secondly, a bit more on the guidance, and hence indirectly what's the impact to the cash flow. But before going into that, so let's look at the first on a trend lines and trends on the two segments. So you see a 5-year trend of pulp and paper improving its profitability, although the last 12 months profitability has been impacted by this raw material pricing, and I'll come back to that with a separate slide. But clearly the trend has been on the improving, and we have a number of actions that both Kim and Jari talked about the Akzo synergies, about the new capacity that we're bringing online in chlorate, and some of the savings that we are getting from the reorganization. So these are all concrete actions that will be yielding improvements in the future. Secondly, if you look at what's happening in the water and industry, or industry and water, there are obviously two distinct businesses. And the old municipal and industrial water, which Antti is, for a reason, it can be proud of it, delivering it to the 15% EBITDA margin in 2016, or very close to it. Clearly that was, and we have said that that's sort of at the level where one cannot expect significant improvement from that level. So that was a good achievement. But on the other hand, and Petri was sort of describing the situation in oil and gas, that has been a difficult market in 2016, continued to carry to 2017 with a difficult pricing environment, but clearly is now on the road to recovery, to really moving that business from severely diluting the margins as it was in 2016. The second half of 2016 was less than 5% EBITDA, to really enhancing the margins as it should be. Actually, by the way, I would like to add here one sort of a note that Pedro mentioned in passing, that when we are becoming an equipment supplier to Canadian oil sands. So this is sort of a one-time thing that we are doing. We're not manufacturing the equipment ourselves, so it's a back-to-back arrangement, but it does enhance our revenues in the second half of the year by some close to 20 million euros. It will come at a profitable business, but not somewhat diluting to our margins. So when you see that, please note that, and that's obviously not repetitive, but it's a strategic sale, because that sort of a transaction allowed us to lock in the customer, and obviously the model for us is that we deliver this blending equipment or delivery equipment, then it's our chemicals that will be used in the operations. But let's look at the raw material prices and sales prices. And this is a slide that you who follow us regularly have seen this. And I don't spend too much time on this one. I just want to show that there's a 10 years of very tight correlation between variable costs and sales prices. And typically it's the way that the variable costs drive changes in sales prices. Typically the lag is 2 to 3 quarters. And you'll see the upswing in the variable costs at the end of the time horizon. So let's focus on 2016 and 17, what has happened in the last 6 quarters. And this is a new picture, and we tried to impact the net impact, or show the net impact of what's happening in the costs and pricing. So light blue is variable costs, and actually as you see, as long as it's below zero, the prices or costs are declining, and then the slope actually, whether the decline is decelerating or accelerating. So until Q2 of 2017, we had an environment where raw material prices generally were declining. And that resulted in a deflationary pricing environment where we tended to see sales prices declining. Much of the decline in sales prices in 2016 was really linked to the raw materials. There were some areas where we have seen increased competition, but for the large part, it was this raw material price driven. In Q1 this year, we saw which one of the one person from the audience was already alluding to that the propylene and ethylene price spike, particularly in North America, so that impacted our variable costs significantly. If you look at the gray area, which then shows the net of the two impacts, the year-on-year change in prices and the year-on-year change in costs, you'll see that for 2016, the net impact was roughly zero. So we had some tailwinds in the beginning of the year and then started to see headwinds at the end of the year. But if you combine the last 2 quarters, that's 35 million headwinds in the first part of 2017. That's pretty dramatic. And this is EBITDA, this is not revenue, this is profit. And this comes directly from the quarterly variance analysis that we provide. So that's the environment where we have been in the first part of the year. And again, if you sort of flip back to the tight correlation that I showed in this chart, there's sort of a promise of statistically reversion to the mean. So let's just leave it at that. So we have to sort of have this tight correlation. Secondly, of course, you saw Thierry's charts. Thierry was showing the petrochemical prices, and they have come down from the spike of spring. So even as we had a new environment with the hurricane impacts, and we see again another increase in propylene and ethylene prices in the last month and this month's price clearing, generally the raw material pricing environment is more stable than it was in the first part of the year. Second, a lot of questions obviously have been asked about our pricing power, whether we are able to pass on these prices to the marketplace. It doesn't come easily, but obviously this is something that we are working on and have been working on and have made several price increases, announcements throughout the year, and obviously are working towards that. So the last bullet point which we write here is that, yes, we expect that this headwind will alleviate in the coming quarters. So it's not a timeline, a precise timeline when it will alleviate, but it certainly we expect and see already signs that this headwind is alleviating. Second topic that I like to raise here and talk a little bit more is our capital expenditures. So the CapEx programs that are mentioned here, they are almost 200 million of CapEx, the first 3 bullet points, of building new chlorate capacity in Brazil, building new chlorate capacity in Finland. It has come at a very good time to the market, like again Jari and Kim mentioned. Clearly enhancing our financial returns both from EBITDA as well as a capital employed point of view. We are bringing all the promised synergies from the AkzoChemical paper chemical acquisition. We needed to invest some 40 million of capex to bring the manufacturing synergies there, and the manufacturing synergies were a significant part of that 20 million or so synergy benefits. Same time, we're also investing on polymer capacity in Europe to really be in a position to take advantage of the growth that we anticipate in oil and gas, including chemical enhanced oil recovery. So it makes us better positioned to take advantage of the opportunities. So, as Jari said, this has been a big phase of almost roughly 200 million per year of capex, which we have had a focus, and we're looking to bring it down. So, give you a guidance that next year capex will be reduced to something in the range of 160 to 180 million. Still a number that is perhaps above the industry norm, but this also already includes capacity expansion in oil and gas. I'm not going to be specifying what capacity expansion it is, and it is still a dynamic market, so we're looking at the opportunities and before we make the final decisions. That's also why the range is relatively wide, but this is that's the guidance for next year. After that, we see us going more towards the industry norm. Industry norm is about 5 to 6% of revenue in capex. Having said that, we still want to say that we maintain flexibility to do on top of that some strategic bigger investments. Kim showed a slide of significant opportunities in chlorate. So chlorate lines are pretty expensive to build. They can be very strategic, very, very good returns from financial point of view. Similarly, Petro was talking about the 100 million or more opportunity in chemical enhanced oil recovery. To take fully advantage of that opportunity, if that opportunity really becomes big, we will need to add more capacity. So those type of a big ticket investments would be then on top of this 5 to 6% capex guidance. But those investments have at least 3 common characteristics. One is that they are strategic investment areas. We will look very carefully that they are financially rewarding, meaning that they are both EBITDA and return on capital employed point of view, enhancing our returns. And third, they can be de-risked to large extent. If you think about I think almost the ultimate is the chlorate line chemical island in Brazil. You have a really firm 15-year offtake agreement. That's de-risking in the cash flows quite a bit. And so even if we don't get quite to that level, we will then de-risking it and knowing that we will have commitments of really solid opportunities before that. So these are not on-spec type acquisitions, or I'm sorry, capital expenditures. Then maybe another point that if we do M&A is not part of this 5 to 6% of capex ratio. So looking at our capitalization, so from 2012 to 14, we were roughly slightly below 2 times leveraged. 250 million EBITDA, roughly 500 million. Again, very big brush, 500 million net debt company. From that, we've now, again, with a very big brush, about 300 million of EBITDA, so some 50 million EBITDA improvement. And if we sort of assume the normal seasonality that we can also use a big brush and talk about 700 million of debt set. So that's 200 million of net debt that has been increased from that time and generating 50 million additional EBITDA. And at the same time, paying 85 million of dividends per year. So the additional debt that Jari mentioned that we have taken and now has really yielded returns. How we fund ourselves, and obviously there are a number of our lending partners here in this room, so our appreciation and thanks to all of you. So we have used quite diversified lending sources, so we are relying on capital markets by issuing bonds. We have bilaterals with banks and multilateral institutions. We like to also keep enough financial flexibility by maintaining a revolving credit line, which on this picture is unfortunately pictured in the wrong year. It actually matures in 2020. But nevertheless, that's there. So summarizing our equity story, it's really continue to improve the profitability. Jari went through the bridge, as we call it, clear, tangible actions that we have underway with an improved or increased focus on cash flow through tighter capital allocation, which the principles which I just went through. So with that, these are the targets how we continue to drive towards the 14 to 16% range while maintaining a conservative financial profile and attractive shareholder-friendly dividend policy along the way. So with that, I'll stop, and I think it's Jari and I both jointly taking questions from the audience.
Yes, we will take questions to Jari and Petri, but also there are a couple of questions on the iPad from the webcast audience, one to Petro and one to Kim, so I'll pick those up also. But let's kick it off with the questions to CEO and CFO. If not anyone here in the room yet, a couple of questions from here, from Mikael Döppel. Could you please quantify the financial impact of the hurricanes?
We said it's limited, but thing is unfolding. We had shutdowns, customers had shutdowns, and we had raw material, lack of raw material, not stopping fully because of that, but not running full capacity. Still keeping it so that not a material effect, as of we know today. Hopefully Maria is not doing next hit. So.
Little bit related to that, there's a question. Given that your EBITDA is down during the first half and the headwinds from the hurricanes and FX, how confident are you in reaching the full year guidance? And what do you see as the key risks related to this?
Well, we didn't change our guidance, so that shows that we're holding to it. We've said since February this year that it will be tail-weighted. If you look at the bridge that I showed and Petri just talked about, many of those things are kicking in the second half of this year, and our organizational structure change is one of those that there was no effect whatsoever in the first half. So with those dynamics that Petri talked about, we sort of knew we were going this way in the year, and now we're tail-weighted and going back. So we maintained our guidance.
Good. Let's take the next question to Kim. There is a question about pulp and paper. What do you think will happen with chlorate prices in Finland now that the Joutseno plant is fully sold out and there is possibly more pulping capacity to be built? would that be something that impacts your profitability?
Well, I don't think it will. Actually, we steer the product line globally, and we ship from Fray Bentos to India, Africa, anywhere. So Joutseno is only one additional mill, and we will steer the pricing globally, so will not impact. To profitability, yes, but to the price levels, most likely not.
Maybe I'll add to that. So the reason that it's sold out, that part of the product can be made into a dry product, so we can export it to the world markets. And obviously, then we optimize on who do we sell and how do we run that, and there's seasonality also. So now Kim is sitting on a number of assets which make it possible to balance where we want to do it. And contracts typically are long-term contracts. We didn't talk about that. We're talking 1 to 3 year contracts. In Clubbing's case, 15-year contracts. So.
Let's take the next question to Petra about oil and gas. Have you seen increased interest towards CEOR now that it seems perhaps that oil prices are not increasing that much anymore, as USA is becoming self-sufficient on energy and electric cars are coming, which would reduce appetite for exploring new oil fields?
Yeah, no, good question. We just need to keep in mind that, first of all, chemical EOR, these are long-term projects, and almost all of them that are already moving forward, they are going to continue to move forward regardless of what happened in the United States. Secondly, they keep getting more efficient. One of our technologies is helping to do that, and with that, they will even accelerate their interest on chemical EOR. So I think that I don't see a substantial negative effect in the interest or demand for those applications.
Good. There's a question in the back of the room.
Hi, a quick follow-up to that. I look at oil and gas as well, and no one wants to talk about their oil sands at the moment. So just from what are you seeing just on the volume-wise? You've guided to 2 million still produced a day from oil sands. How are you seeing that going forward?
Yeah. Well, oil sands was one of those areas that was supposed to be out after everything that happened 2 years back. And like any other industry, they found their way, right? Number one, the capex is already there. So it's easier just to keep it moving forward, to keep these plants operating that you're shutting down. So we need to keep that in mind. So the only option that they have is to do what they have done. Number one is consolidation of many companies to reduce costs. And secondly, looking to the efficiency. So they have been working really hard on those areas. And again, Kemira has been an important part on getting involved into these areas and help these companies to reduce their costs. So if you look at public information, there are more than 2 million barrels of oil still being produced. It can go all the way to 3 million, obviously depending on what source do you use. But I think that's stable and most likely will continue. And the last piece that we need to highlight is that when you go to oil sands, it's a general term, there are two ways to extract this bitumen, right, this oil. One is the standard mining process, and that's the one that we're referring that will stay there for a long time because the capex is already there. But then there is other technologies, in situ technologies, that are cheaper, easier, and faster that they are developing. So for me, again, oil sands will continue to be there for a long time, and I don't foresee that being lower than 2 to 3 million barrels a day.
You know, if I may add to that, so we don't bank on that the production capacity will go up. We're very much dealing with the tailings treatment, water treatment in there, and there the regulation is going up, and they even have to now retreat their old tailings ponds. And that's what we are then after with our knowledge of water treatment, with our polymers, and so on. We're partially in the production phase, but mostly in the tailings and water treatment phase.
Couple of questions. First Panu and then Robin.
Panu Laitimäki, Danske. What is the earnings contribution from the chlorate expansion that was completed ahead of schedule? Just trying to think of the magnitude of this positive thing.
Nice. I won't go, Panu, there because that's so deep to our market knowledge. But it is a nice contribution, and Petri clearly said, and I've said that the capital employed, the return is really healthy, and the EBITDA contribution is healthy. So hopefully we find good opportunities of making club beans and yacht centers, but obviously we have to be in balance with the market so that we don't ourselves destroy the market.
Actually, I meant the contribution for this year.
This year? Well, we're ramping up, so not a huge one, but some millions.
Okay, then I would actually have a second question, going back to this raw material price lag that you are seeing. So if you mostly do contracts with quarterly updates, do you already have a visibility of what you will pay for most of the stuff you buy at the end of this year?
Thierry, now careful, because we've got all kinds of ears and eyes out there.
Yeah, I'm sure. Well, giving a precise number is difficult to your question. As you have seen, we have a number of moving parts that are influencing what's happening. There was a trend to go in a soft landing towards the end of the year. So how much the spike we see at the moment, clearly on certain territories, meaning North America, and certain chemicals, meaning ethylene and propylene, will last. That's a big question mark. Things are returning to operation and almost normal in a pretty fast manner at the moment. So the fundamentals being those, the spike is very opportunistic and should not last very long. But who am I to predict the future?
There's a question to our CFO about CapEx, but Robin, you had to raise your hand, so please go ahead first.
Yes, I was wondering if you can provide a short update on the situation with Huntsman or Venator, both for this year and perhaps the expectation for 2018 as well. Thanks.
Okay, no really dramatic update since we updated on really after Q2. So we'll continue to manage. We have some mitigation actions that how we are sourcing the raw materials. So we are, first of all, we have now assurances that we have enough raw material so that we can produce the coagulants that are needed in the marketplace. So there should not be revenue drop from that sense, from coagulants. The revenue drop that we have from passing on the electricity sales, that will continue through 2017 and will gradually diminish in 2018 depending on how quickly Huntsman or Venator brings the facility in Pori online. The additional costs that we need to bear because of these workarounds and mitigation actions, those are impacting profitability. And like I said, in the past, we have this business interruption insurance that covers our losses up to 10 million. So the gross margin loss that we expect to get in 2017, other than the deductible, which is 250,000, will be covered from the insurance. So no impact other than that in 2017. The insurance cover is 18 months or 10 million. So depending on how long it will take before Venator brings the facility online and before we get the fresh copperas from that, there might be a time where we may run out of cover. That really depends on the success of the mitigation actions. That depends on really the timing when Venator brings the facility online, and we really don't have an estimate on, or don't want to put a guesstimate on that number, but it's something.
Good, thanks. And just briefly, if I may, on the run rate of the cost reduction from the segment, from two segments brought together this year in Q3 and Q4, should we expect already a material impact, or is it mainly for 2018?
Well, the full impact will be 2018. So really, like we said, we calculated the benefits that we are getting by the end of this year. So de facto, it means a full year impact next year. We are getting some benefit, like very little benefit in second quarter. We are getting some Some benefits in third quarter, a bit more. Whether that's fully linear for modeling purposes, you may use that. But really the full benefit is 2018.
Good. Thank you very much.
Okay. Our sell side analysts are very active asking questions. So a couple of questions from here. To CFO, assuming no planned expansions in 2018, where would the CapEx then land at? And is it correctly calculated that assuming 200 million CapEx for 2018, that would include around 60 to 70 million CapEx for a new unmentioned plant in oil and gas?
I'm not sure if I get the mic to work. Anytime you give up something, you get a next layer of the onion to be asked to be to peeled. I don't think you can do that backward engineering quite like that. So the 60 million for oil and gas expansion is not the correct answer. I'm not going to give the right answer either, but it's not quite that. It's a bit more complicated than that. And I will not either give out the answer on what the CapEx would be without that, because that would then give the answer on how much we intend to invest, and I think we don't like to give that number now. If you look at my charts, I think you see how much is maintenance and improvement CapEx. It doesn't have a number next to it, but you sort of can figure out that it's perhaps 110 million is a run rate, 100 to 110 million is the pure maintenance and improvement CapEx. So that's a number that we can give out, and we also separate that in our reports, how much we put on maintenance and improvement CapEx. Is that good enough answer?
That's good. Okay, a second one. In Jari's presentation, it was mentioned that cash flow and CapEx would be more balanced going forward, and there's less appetite to increase net debt from here. Would you stick to this even with the full 200 million CapEx spending for 2018?
Well, obviously, the whole thing depends on how we see the cash flow generating for all the activities and when it is balanced. But I expect our base CapEx without these exceptional sort of one-time investments, those in level should be coming down in the future years in relative terms. As we have said, we've been running at 200 million level on average 3 years now. So down from there. Then it comes from timing. And this is why it gets sort of, do we start an investment 1st of January or 1st of July? It impacts a 12-year period, 12-month period. So these are the things that we need to then look at. But if you look at the next 2-3 years, the level should come down from the 200. Or cash generation up, which is also expected. So balanced and not growing our net debt. And don't look at quarters, don't look at halves, look at the longer period.
Very good. Okay, before I will instruct about the breakout sessions, we will conclude with the concluding remarks by CEO. So Jari, please conclude the event, and then we will end the webcast, and I will instruct you about the breakout sessions.
Okay, thank you, Olli. So we have covered sort of the general business area, which I talked about, then Antti and Kim going through the two segments, then having a deep dive in the oil and gas and definitely to the raw material sourcing side of things, and Petri looking then at the financial dimension of those. And hopefully you have a better picture now where the business is and where it's going and what our main plans are. And as said, nothing huge new to report. We're executing the plan as it is and adapting as need be. If I look at what has changed since last year when we were here in this same hall, definitely is that oil and gas industries is back, and they report to be viable at the 50% barrel level, making cash and being able to invest. And certainly the shale industry in North America has proven that. End of 2014, we were running at 1,900 drilling rigs. Drilling is an indirect thing, making holes, and then some of them are fracked, but it gives some indication. Summer of 16, we saw a level of 400, from almost 2,000 to 400, and now we're at 950 or 60 rigs. So in 1 year, it has over doubled. The other thing is that productivity has gone up in a big way. There used to be stats out there for everyone to see, and in 14 the average drill time was about 21 days for a rig for those 2,000 rigs. Today is said to be 7 to 10 days. So those 960 rigs are much more efficient than 2-3 years ago, and that's the cost thing that is out there. So oil and gas is back. And in a different thing and recovering. We still have work to do to get our business right, our pricing right, our margins back onto the level we want to see them, but that's going to the right direction. Petri talked about the dynamics on the raw materials and prices. So we saw those flattening out and normalizing during the summer and early part of Q3. And in a big picture, we see that continuing. There might be a US kind of a thing for some time on back of the hurricanes, but that's a localized short-term thing, not a long-term thing. The organizational structure is now streamlined and we're fit for fight and having internal synergies and faster decision makings and took some management layers out, benefiting also to the cost side, but more I'm looking for the efficiency of the organization to compete in the market. A lot of the expansions that we have initiated during the last 2-3 years are coming to finalization. Joutseno chlorate, one of those, and starting to yield into our productivity and more revenue and definitely more profit. Operational excellence, various aspects that we are doing there are progressing, and not all is easy, but we definitely are looking now that the transportation will contribute starting next year in a nice way to our Boost program. And then you heard the R&D initiatives and way we are looking at and pushing to renew portfolio, bringing new, more sustainable products and solutions to the market. Our financial targets have not changed. We continue to deliver the business, and also on the M&A side, we are careful, but our ears and eyes are open. But as you have seen, we've not done anything in the last 2 years, and we will focus now on cash flow and the cap expenditure. There will be timing issues, but as a general rule, they should come to balance, and our net debt should not go up in the year to come. So full focus now next on focusing on reaching and delivering that 14 to 16% operative EBITDA. Next, we'll move on to the breakout sessions, and then you have various rooms where we'll circulate around. Many of you know the system, so then there's opportunity to have more questions after the session. Thank you very much.